Welcome back to another episode of Market Brief After Hours. It's been a fascinating midweek session. We started the day with what looked like a celebration, green arrows everywhere, optimism bubbling over. But by the time the closing bell rang, the mood had shifted completely. It feels like the market couldn't quite decide if good news was actually good news.
That is the perfect way to describe it. We saw a classic pop and drop. Initially, investors were cheering the U.S. jobs report, which showed serious resilience in the labor market. But as the day wore on, that enthusiasm just evaporated. The narrative shifted from the economy is strong back to, oh no, if the economy is this strong, interest rates aren't coming down anytime soon.
It's the old bad news is good news is bad news dynamic. Let's look at the scoreboard for the U.S. indices. It wasn't a disaster, but it certainly wasn't the rally we saw at breakfast.
Right. The momentum just cooled significantly into the close. The Dow Jones Industrial Average ended its three-day winning streak. It fell about 67 points or 0.13%, closing at 50,121. What hurts there is that the Dow was actually up more than 300 points earlier in the session.
That is a significant reversal. And the broader market?
Similar story. The S&P 500 gave back almost all its intraday gains. It had risen as much as 0.7%, but ended up edging down less than a point to close at 6,941. And the Nasdaq Composite, which is usually the most sensitive to these mood swings, slipped 0.16% to finish at 23,066.
So tech was the drag again?
Exactly. When investors start worrying about interest rates staying high, they sell software and tech. We saw Salesforce down 4% and ServiceNow dropping 5%. The iShares Expanded Tech Software Sector ETF is now nearly 30% below its 52-week high. It's been a brutal stretch for that specific corner of the market.
Let's dig into the catalyst here. You mentioned the jobs report. The headline number was a beat, right?
It was a significant beat. Non-farm payrolls increased by 130,000 in January. The estimate was only 55,000. So on the surface, the labor market is booming. The unemployment rate dipped to 4.3%, and wages are up 3.7% annually.
So why the skepticism? Why did the market fade if the economy is pumping out jobs?
Because the devil is in the revisions. While January looked good, the benchmark revisions showed that payroll growth from April 2024 to March 2025 was actually 898,000 lower than previously reported. That is a massive number. It suggests the economy wasn't nearly as hot last year as we thought. Plus, average monthly job growth last year was revised down to just 15,000.
That paints a very different picture. It sounds less like a boom and more like a stagnation that we just didn't see clearly.
Precisely. And to add to the confusion, December retail sales were flat. They missed expectations for a 0.4% increase. So you have this weird mix, a sudden pop in January jobs, but historical weakness and consumers who are tightening their belts. That confusion drove Treasury yields higher. The 10-year yield pushed up to 4.174%, and the 30-year hit 4.814%. When yields go up, stocks, especially tech stocks, usually go down.
Let's hop across the Atlantic. It seemed like Europe had a slightly better day, or at least a more mixed one.
Europe was definitely a mixed bag, mostly focused on earnings. The Pan-European Stock 600 managed to squeak out a 0.1% gain. The standout was the UK. The FTSE 100 rallied 1.31% to hit a record near 10,480. That was driven by the old economy stocks, miners, oil majors, home builders.
And the rest of the continent?
France's CAC 40 was essentially flat, gaining just 3 points to sit at 8,331. Germany's DAX 40 struggled, falling about 0.5% to 24,880, mostly due to caution around AI stocks. Italy's FTSE MIB was also down, dropping 0.45% to 46,594 after industrial production numbers disappointed.
I saw some big single stock moves in Europe, too.
Huge moves. Heineken rose roughly 4%, which is interesting because they announced 5,000 to 6,000 job cuts. The market often rewards cost cutting. On the flip side, Dassault Systems plunged more than 20% after their earnings release. That is a massive haircut for a major company.
Before we get into the commodities and the very active Forex market, let's take a quick break. We'll be right back. And we are back on Market Brief After Hours. We've covered the equities, but the commodity markets were flashing some bright signals today, particularly in the metals.
Absolutely. Gold is having a moment.
It rebounded strongly, gaining 1.26% to close at a staggering $5,087. We are firmly above the $5,000 mark now.
That is a huge psychological level. Is the technical picture supporting this?
It looks very bullish. Gold is trading well above its 50-day simple moving average of $4,588 and its 200-day average of $3,839. When you see the moving averages fanning out like that, it's a classic bullish configuration. The next major target is likely $5,200.
And silver?
Silver actually outperformed gold in percentage terms. It surged 4.62% to end at $84.53. It formed a large bullish candle, which usually indicates aggressive buying. It's trading way above its 50-day average of $78.37. The momentum there is intense.
Oil was also on the move, likely due to the geopolitical headlines we're seeing.
Yes, Brent crude climbed 1.32% to $69.71, and U.S. West Texas Intermediate rose 1.56% to $64.96. This is mostly about fear premium returning. Tensions between the U.S. and Iran are heightened, and despite U.S. crude inventories actually increasing by over 13 million barrels, which usually pushes prices down, the geopolitical risk outweighed the supply data.
Let's shift gears to the foreign exchange markets. There is a lot of technical data to unpack here for the traders listening. Let's start with the euro against the dollar.
The euro-USD is in a consolidation phase. It closed down slightly at 1.1874. The key takeaway here is support. The pair is holding firmly above its 50-day simple moving average at 1.1747. As long as it stays above that level, and certainly above the 200-day at 1.1627, the broader bullish trend remains intact. It's currently stuck under resistance at 1.1927.
And the British pound?
Similar story. GBP/USD pulled back a bit, down 0.12% to 1.3626. It's retreating from recent highs, but the structure is still positive. It's holding above the rising 50-day SMA at 1.3493. If it breaks below the session low of 1.3510, we might see a deeper correction. But for now, the uptrend is holding.
The Aussie dollar seemed to buck the trend of the other majors.
It did. The AUD/USD had a great session, advancing 0.73% to 0.7126. It's making fresh highs. Technically, it's looking very strong, trading well above the 50-day SMA of 0.6768. There are no signs of exhaustion there yet.
However, the biggest drama in FX was undoubtedly the Japanese yen.
That was a collapse. The USD/JPY plummeted 0.74% to close at 153.22. Technically, this is significant damage. It broke decisively below both the 50-day SMA at 156.21 and the 100-day SMA at 154.45.
So the bullish channel is broken?
It certainly looks compromised in the short term. The pair closed near its daily lows, which is a bearish signal. However, the long-term support, the 200-day SMA, is down at 150.36. That is the line in the sand. If it drops to that level, we are looking at a major trend change. For now, the near-term bias has flipped to bearish.
Finally, let's look at the individual stock movers. We mentioned the tech weakness earlier, but there were some violent moves in individual names today.
Volatility was the name of the game. Let's start with the losers. Unity Software just got crushed. Shares dropped nearly 27%.
Ouch, was it earnings?
It was the outlook. Their first quarter revenue guidance came in at $480 to $490 million, missing the expectation of $492 million. In this market, if you guide low, you get punished instantly.
Who else had a rough day?
Mattel tumbled 25%. They missed earnings badly, 39 cents per share versus the 54 cents expected, and issued weak guidance. Zillow also fell 16% on soft EBITDA guidance.
Was there any green on the screen?
There is a bright spot in the auto tech space. BorgWarner surged about 23%. They announced turbine generator contracts tied to AI infrastructure.
Everything comes back to AI eventually, doesn't it?
It really does. If you can tie your business to data centers or AI power needs, the market loves you. Even McDonald's reported today. They beat expectations, but the stock was flat, closing at $323.21. It seems investors are looking for growth stories, not just steady burgers.
It's a complex picture. We have strong headline jobs numbers, but weak revisions. We have record highs in the UK, but tech selling off in the US. What is the main takeaway for investors heading into tomorrow?
The market is struggling to sustain a rally because the focus has shifted entirely to the Federal Reserve. The blowout jobs number, despite the revisions, makes traders worry that interest rates will stay high. The market is looking for clarity. Until we get to the next Fed policy meeting, we might be stuck in this choppy environment where good economic news is treated with skepticism.
We will certainly be watching closely. That wraps up our deep dive for today. If you found this useful, please follow Market Brief After Hours on your podcast platform of choice. We appreciate you listening.